buy big when the liquidity is starting to dry up, and then we can take advantage of the bids off the 95s up to the 20s and make ourselves 25 ticks of profit. Make ourselves 25 ticks of profit. Now, I bought that as the price came down, and the reason why I bought it as the price came down was because it had already broken the wholesale. If you bought it at the close of the candle, you still went straight into profit. You had a maximum drawdown of just 2 ticks. So you'd have been able to take advantage of the buy at 71s and still made 20 to 25 ticks profit on the upside. So when you see that trade there, you think to yourself, wow, that is absolutely fantastic as a trade opportunity. Absolutely brilliant. But you were obviously aware of the order flow narrative. You were aware of the liquidity that was a problem at 71 handle, and therefore you were able to take a little bit more of a passive approach to this trade until you got that liquidity break of the handle. You weren't really getting too involved in it. And then you got the liquidity break at the handle, and then you smashed it. You absolutely smashed it. Took the market bid, and sure enough, straight into profits, straight into the trade, straight into the money, and now 25 ticks better off, with the potential that we might end up at 71.50s. If we end up at 71.50s, of course, $500 a contract. Crazy, 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 crazy. Beautiful. Did anybody get any of that big ripper on the gold market for $1,000? What a stoter. Absolute stoter of a top edge. It was a beauty. The only downside was if you waited for level 2 liquidity, you never got it. So here's the ripper of gold. You can see what happened here. You would have got a big sale on the dollar. We'd got a big sale on the euro. That was a dollar rally, of course. Did Paul not mention that the gold's got some sort of anchor attached to it that's going to pull the price straight through the floor? There was something that Paul said earlier. I can't remember what the comment was, but it was some comment that the Titanic, that's it. So there you go, guys. Somebody in this room is making a comment that the gold market is going to sink like the Titanic. Shortly after that comment, the gold price dropped by over $1,000 a contract. It shows you guys that it just takes a little bit of time, a little bit of work. And if you know it's going to sink like a Titanic, what should you not be doing? Missing it. It's one of those occasions that's going to get Leonardo DiCaprio involved in a film because it's such a good sell. And you can start to recognize the sell, but it doesn't give you a level 2. It doesn't give you the opportunity to get the best trades because it's too good a trade. Sellers are already in it. Sellers are already connected. So you cannot miss that sell if gold's your thing. If gold's your thing. That's why we teach you to trade on the sell limit orders and the sell stop orders. So that if you don't get the top price, you get the momentum entry and you're in the trade when you want to be in the trade. And that was absolutely superb. So well done, Paul. I like it. Gold has got all the characteristics of a Titanic at the top edge here. Sunk without a trace, guys. Sunk without a trace. Remember we told you oil would probably get up to 71.50s? Oil's just traded 71.42s, guys. 71.42s. Do you like that, Michael? Damn right you like that. That's a great trade, guys. 50 ticks of profit. 95s to 45s is 50 ticks of profit. $500 per contract off the bottom edge, called live in this room. We told you it was going to run the stops. We told you we were going to smash it. If it did run the stops, we did smash it when it ran the stops, and now we've made $500 profit per contract off the bottom edges. You can't make this stuff up. It's that good, guys. Beautiful. Well done, guys.